Here is something that surprises almost everyone the first time they hear it. Some of the most tax-efficient retirees in America deliberately choose to pay more in taxes in certain years, not because they have to, not because they made a mistake, but because they ran the math and they realized that paying a little more now saves them significantly more later. It may sound counterintuitive, and it is counterintuitive, but it is also one of the most legitimate and most overlooked strategies in retirement planning. It's called bracket filling, and by the end of this video, you will understand exactly how it works and whether it applies to your situation right now. Before we get to the strategy, let's make sure we're clear on how tax brackets actually function, because one of the most persistent misconceptions in personal finance is that earning more money can somehow result in less take-home pay because it, quote, pushes you into a higher bracket. That is not how brackets work. The US tax system is progressive and marginal. That means each bracket only applies to the income that falls within it and not to all of your income. Here's a simplified example for a married couple filing jointly in 2026. The first roughly $24,800 of taxable income is taxed at 10%. Income from $24,801 to $100,800 is taxed at 12%. Income from $100,801 to $211,400 is taxed at 22%. Income from $211,401 to $403,550 is taxed at 24%. So if a married couple has $110,000 of taxable income, they do not pay 22% on all of it. They pay 10% on the first portion, 12% on the second portion, and 22% only on the dollars that exceeds the 22% threshold. Why does this matter for the strategy we're about to discuss? Because it means there is always a specific amount of room inside your current bracket, a number of dollars you could recognize as income this year without crossing into the next higher tax bracket. And that room is the raw material of bracket filling. Here is the mindset shift that changes everything. Most people think about taxes 1 year at a time. The goal, as they understand it, is to minimize what they owe this April, defer income, maximize deductions, keep taxable income as low as possible right now. That thinking is not wrong, but it is incomplete because taxes are not a single year event. They are a lifetime event, and optimizing for the lowest tax bill this year can and often does produce a much larger tax bill over the full arc of your retirement. Here is the scenario that plays out for millions of Americans. You spend your entire working life contributing to a traditional 401k. Every year, you reduce your taxable income by the maximum contribution. Every year, your tax bill this year goes down. Then you retire. Your income drops. You have a window of potentially 5 to 15 years where your taxable income is genuinely low, lower than it was during your peak earning years. But then required minimum distributions begin at age 73 or 75, depending on your birth year, and the IRS starts sending you a bill every year automatically for a growing percentage of the account you spent decades building. That bill doesn't care whether you need the money. It doesn't care whether the market just dropped. It arrives on schedule, and it pushes your income and your tax rate higher than it may have been at any point in your working life. Bracket filling is the strategy of using that low income window, the years between retirement and RMDs, to deliberately recognize income at today's lower rates, reducing the size of the future tax bill before it becomes mandatory. Let me walk you through exactly how this works with a real example. A married couple retires at 63. Their Social Security start date is 67. They have $1.1 million in a traditional IRA and $180,000 in a Roth IRA. Their annual living expenses are $70,000, which they're drawing from savings and a small pension. Their taxable income right now, before any additional strategy, is relatively modest. After the standard deduction, they're sitting comfortably in the 12% bracket. And the top of the 12% bracket for a married couple is approximately $100,800 of taxable income. That gap between where they are and where the 22% bracket begins, That is the bracket filling opportunity. Each year, they convert a portion of their traditional IRA to a Roth IRA, carefully calibrated to fit that bracket without crossing into 22%. Let's say they convert $30,000 per year. They pay 12% federal tax on that $30,000, which is $3,600 of tax. They do this for 7 years, from age 63 to 70. The total converted is $210,000, and the total tax paid on those conversions is approximately $25,200 at the 12% rate. Now let's look at what happens if they don't do this. At 73, their traditional IRA, which has continued to grow, requires a minimum distribution of approximately $50,000 or more. Combined with Social Security, their taxable income is now well into the 22% bracket. Up to 85% of their Social Security becomes taxable, and this continues and potentially grows every year for the rest of their lives. The tax they pay on that $210,000 at 22% rather than 12% is approximately $46,200, nearly double. The bracket filling strategy saved this couple roughly $21,000 on that portion of their IRA alone. In the Roth account those conversions created, it now grows tax-free. Every dollar of future growth is permanently sheltered from taxation. No RMDs, no future tax bills, complete flexibility. Bracket filling is a concept. These are the 3 tools that implement it. The first tool is Roth conversions, the one we just walked through, converting traditional IRA or 401k money to Roth in deliberately calibrated amounts during low-income years. This is the most powerful and most commonly applicable bracket filling tool for pre-retirees and early retirees. The second tool is capital gains harvesting, and it's the one that surprises people. For married couples with taxable income below approximately $98,900, the federal long-term capital gains tax rate is 0%. 0. If you have appreciated investments in a taxable brokerage account, you can sell them, realize the gain, pay no federal capital gains tax, and either reinvest immediately or to redirect the proceeds. This resets your cost basis at the higher level, reducing your future taxable gain when you eventually do sell in a higher income year. This strategy is called tax gain harvesting, the opposite of the more familiar tax loss harvesting, and it is only available in low-income years, which makes the retirement window before RMDs and peak Social Security income the ideal time to use it. The last tool is using Social Security timing as a tax lever. By delaying Social Security to age 70, it does 2 things simultaneously. It increases your monthly benefit by approximately 8% per year beyond full retirement age, a guaranteed return that is very difficult to beat. And it extends the low-income window during which bracket filling is most effective. Every year you delay Social Security is another year without pushing you into a higher income tax bracket. Another year of conversion space, another year of potential zero-rate capital gains harvesting. The strategies compound together. Let me give you a clear action plan based on where you are right now. If you're in your 40s, the bracket filling window is a long way off, but the decisions you make now shape its size. Diversifying your retirement savings across both traditional and Roth accounts gives you a flexibility later. A mix of traditional 401k contributions for the current tax year deduction and Roth IRA contributions for future tax-free income is often the right posture. You want options in retirement. Options require different account types. If you're in your 50s, start modeling what your RMD picture looks like at 73. If your traditional accounts are large and growing, the bracket filling conversation becomes more urgent. This is also the decade when many people's income is at its peak mean. Roth conversions may be less attractive right now, but planning for the retirement income window ahead is essential. If you're already retired or within 5 years of retirement, the window is open or opening. This is when the strategy becomes most actionable. Work with a financial advisor to calculate your bracket space each year, the precise gap between your current taxable income and the next bracket ceiling. Fill it deliberately, annually, for as long as the window allows. The tax code is not simple, But the core idea behind bracket filling is every dollar you convert or recognize at 12% is a dollar that will never be taxed at 22 or 24%. Every year you use the low income window intentionally is a year that reduces the size of the mandatory tax bill waiting at age 73. The goal was never to pay the lowest possible taxes this year. The goal is to pay the lowest possible taxes over your lifetime. And those two goals, optimized independently, often produce completely different strategies. The families who understand that distinction tend to keep significantly more of what they built. And the difference rarely comes from earning more or investing better. It comes from planning smarter. If this raised questions about your own tax picture, about whether you have bracket space, whether Roth conversions make sense, or what your RMD exposure looks like, those are exactly the kinds of questions worth working through with a financial advisor who can run your specific numbers. Subscribe for more content like this, and I'll see you in the next video.